Hey everybody, this video is going to go into a bit about savings basics, focuses on savings, a little bit about investing, and what it says below there, subtitle obviously, why we do it, concepts and behaviors. So you may have noticed this class is a mix of a few different things. Partly we have to learn some conceptual things, just like how things work. We also then focus on behaviors, how we go about our life, disciplines that we incorporate, that sort of thing, to get to where we want to be. Behavior is really important. And then also spiritual practices and our like spiritual attitudes, our philosophy, our perspective. So this particular presentation is going to focus mostly on concepts and a little bit on behaviors. And then later in the week, like when we get together, we will talk a little bit more about our perspectives and our philosophy, and then we'll kind of continue on with those different ideas. So just going to get into it here and look at some concepts. And these do draw a lot from the pretest that you guys did. And so starting off with this idea of time value of money, and you may have instinctively understood a little bit what that was. I'm just going to read these bullet points for you and then talk about them a bit. So some key ideas. Time value of money is based on the idea that people would rather have money today than in the future. Given that money can earn compound interest, it is more valuable in the present rather than the future. The formula for computing time value of money considers the payment now, the future value, the interest rate, and the time frame. And the number of compounding periods during each time frame is an important determinant in the time value of money formula as well. So I will talk about compound interest toward the end of this presentation, but I know that phrase may be a little bit like, well, what is that? The important thing here about time value of money is it draws off that concept, but the main idea of it is money is worth more to me now than you telling me I will receive it in the future. And that might sound greedy or something, but it's partly based on what I can do with it. I could invest it, right, and make money off it. But it's also just the fact that, like it says here, if I'm given some money today, let's say there's a sum of money, somehow I receive $10,000 today, well, I can use it today. That has value. That has worth to me in my life. I could invest it in myself, like spending it on a course of some kind, or I could invest it in some of the investments we talked about, real estate or mutual funds or something. Or I could just spend it on something today that I would get lasting enjoyment from. And like a motorcycle or a boat, a phone, clothes, books, whatever. Obviously, there are some purchases here that are going to have more worth than others in terms of how I will benefit financially down the road. But in all cases here, I'm getting some, we call it utility, which basically means some enjoyment or happiness out of the thing. And maybe I'm just going to really enjoy a book, but I also learn from it, right? And so maybe that's going to benefit me in terms of my decisions down the road, how I relate to people, the how well I do on my tests, um, future financial decisions, all sorts of things, right? So if I have that money now, I get the benefit from it now versus waiting on this. And this is why lottery winners, by the way, you can, if you win the lottery, you can either take that money, as they call it, a lump sum. Let's say it's like $3 million, or you can get a promised payout over lots and lots of years that all totaled would wind up being, let's say, $6 million. So your first impulse is like, well, of course I'd want the $6 million, but it's the reason they offer it like this is because of the time value of the money. It's the understanding that if they pay out that 3 million now, well, I could turn around and invest it. I could use it how I want to now, instead of it just being drawn out. And then meanwhile, obviously, if they only give you your money in pieces, what are they going to do with the money they're not giving you up front? Well, they're going to invest it and make interest off it, and that's why they can afford to do that. And so that said, for money I don't need to use today, it does make sense to place it somewhere I can get a return. Well, what returns are reasonable? It depends on when we'll need the money. And so we talked a little already about one thing we would save toward, which is an emergency fund, which very plainly is for emergencies. And I put the whoa, like no kidding, right? And this is particularly when you are, getting into your adult life, starting to need to worry about more expenses and that sort of thing. But even today, we can save toward other goals, and one of those in particular is called a sinking fund. And that word or phrase is maybe a little less clear, but this is for something you would just like to buy. And in your situation in life right now, the ages you guys are, this might be more relevant for you. Okay, so a sinking fund. Here's the idea of it. Imagine there's a phone you want to buy that costs 1.5 million Colombian pesos. So, and you determine you can save 125,000 pesos each month. When will you be able to buy the phone? Well, it's quite simple to figure that out. All you need to do is take that 1.5 million, divide it by the 125,000, and since this has been on a monthly basis, that tells you when you get the result of 12, it means in 12 months you'll be able to buy the phone. And this, of course, assumes that you don't have anything to start with. If you had started out with some of that money, then you wouldn't have to save for as long, right? You could shave some months off that. But starting from zero, then this is how long it would take. Well, let's just imagine that you'd say, you know what, I'm not happy about that. I want to buy the phone sooner. So you decide that instead you'd like to buy the phone in 8 months. And you're willing to cut some spending in some other areas and to make some extra money, however you want to do that. Maybe sell some jewelry or, whatever kind of extra work you can do. How much would you need to save each month if instead you want to buy it in 8 months? Well, the price hasn't changed, right? The price is still 1.5 million pesos. But now I'm going to divide by the number of months, which is 8. And now I'm going to just say, okay, 1.5 million divided by 8 is 187,500. So that tells me to buy the phone in 8 months with no interest, and assuming that there's no price reduction in that time, you would need to save 187,500 pesos each month. Also assuming you have nothing to start with again. Okay. And then you might say, well, okay, that sounds like a lot to say, but I could probably get some interest in there, and that's true. You could conceivably accrue some interest while saving toward a purchase in a sinking fund. Truthfully, though, unfortunately, interest rates are very low when you're talking about more liquid investments. Hopefully, you guys remember what that is. It's like money that's more accessible for you, which is what you would want in this case because you're anticipating taking this money out pretty soon. It's not like something 5 or 10 or 20 years down the road, right? You're talking in a year or less. And so normally when we look at how much we need to save toward a sinking fund, toward a specific purchase, we don't really factor interest in that. If you happen to get a little bit, then great. And that's a bonus for you. But we'd base our target on just no interest. For long-term goals, though, we can be more aggressive in terms of where we put our money, and we can also be willing and able to ride the ups and downs of the stock market because we have much more time to ride them out. If the stock market goes just down a little bit and we've invested in stocks or mutual funds, which are dependent on the stock market, it goes down for a little bit, you lose some money, it's okay. You can wait a little longer and it'll go back up. That would be a big problem, though, if you're saving for something that's just a year away and then it goes down right in at the beginning. You don't have time to make that up. For a 30-year project, though, you do. And so this brings in a concept that's really important, and it's called the Rule of 72. And what is the Rule of 72? Well, it's just a mathematical principle that states that 72 divided by your interest rate will tell you how often your money will double. And I know off the bat that's confusing, but that's why I'm going to show what I mean here. Let's say, for example, I can find a way to get a 4% interest rate annually. 4% interest rate means if I put in $100 at the very beginning of the year, at the end of the year, I would have $104. Okay? So the rule of 72 says 72 divided by 4 equals 18. So this means my money doubles every 18 years if I just put in a one-time investment and I don't add anything to it as the years go by. And it's just it just happens to work this way. It's really handy and interesting to me. So anyway, what that means is if I invest $1,000 and it's going to be a steady rate of 4%, it just continues going up at that rate. At 4% interest, well, that 1,000 becomes $2,000 in 18 years, and then 4,000 in 36 years, because I said my money doubles every 18 years. Hopefully that makes sense. But I will give a second example here. I'm going to keep it moving because I don't have tons of time. How much would you expect a 6% interest rate to yield by year 36? Well, obviously it's a little bit better than 4%, right? But doesn't look like it'd make that big a difference between 4 and 6, but we'll take a look. This time I say 72 divided by 6 is 12. So that means instead of it doubling every 12 years, my money is doubling instead of it doubling every 18 years, it doubles every 12 years. Because 72 divided by 6 is 12, money doubles every 12 years. So starting with the same initial investment, that 1,000 now becomes 2,000 at year 12, so quite a bit faster. Then it becomes 4,000 at year 24. And that's years before it would have at a 4% rate, right? And then finally it becomes 8,000 at year 36. So we can see the interest rate just looked a little bit better, but my money actually is twice as much in 36 years, just by getting that better rate. Okay, now the question is, could we hope for better, and dare we try something like 12%? Well, let's see what happens. 72 divided by 12 is 6, and that means 1,000 becomes 2,000 in year 6. We're on a much faster pace here, right? Then 4,000 in year 12. It becomes 8,000 in year 18. And then 16,000 year 24. 32,000 in year 60. Sorry, year 30. I keep misspeaking and I'm sorry. And 64,000 in year 36. So, this is only, it's just twice the rate we just looked at, and yet we're up to $64,000 instead of the 8,000. And then let's think about it a little more. What if we had started with $2,000 instead of $1,000? Or imagine we waited for another 6 years. You can see how dramatic this can be. If we'd started with 2,000, that means we would actually end up at 128,000 in year 36. Or if we wait another 6 years, it'd be 128,000. If it was both, that'd be 256,000. It's pretty nuts. And the question is, well, is that reasonable? I'm not going to show this, but this is an example mutual fund that has returned on average 12% each year over a long period of time. Now, it's not actually a steady 12%. It's going to be up and down. And so for that reason, it's not going to look this clean. Your returns at the end of it wouldn't be quite like this, but it would be an approximation. Okay. And so, yeah. So this is what this looks like. We've got a breakdown, a chart here where 24 years and 12 years at 6%. So this is looking pretty similar to what we saw, but it is for a longer period of time, going all the way up to 48 years. And then all the way in the end here, we see 18%, right? $2,000 after 4 years, and then this is starting with 1,000, just like we did. And then it gets all the way up to $4 million in 48 years. And you're like, well, okay, but is there an 18% rate out there? For you, no, there's not. Not one that's consistent anyway. But there is one out there in the world. What is that 18%? That would be a credit card. So what do we mean here? It means that if a credit card company lent you $1,000 at 18% and you never paid a dime on it, and then 48 years later you decided, okay, I just want to pay it all off all at once, you would owe them $4 million. Now the thing is, that is illegal. Credit card companies have to require a minimum payment from you, and it gets a bit more technical than that, and I'll get more into that later. But it just shows you the dangers of borrowing money and also the wonders of saving money. Okay, so I'm about out of time here, and this was an intro to kind of the why of this, but there's a lot more to be said here, particularly about the how and the where. And that's why I said there's more to come on this later. We'll look at the how, such as dollar cost averaging, mutual funds, stocks, real estate, and the tax shelters, how these things all come together. And I think I just want to take my last few seconds, and I'm going to end here back on, well, I'll just go to looking at this chart again so you can see the breakdown. hopefully this made some sense for you, and I'll see you all in class.